Hi everyone, and welcome back to this video series on market timing strategies based on contrarian signals. Today, I'm going to show an implementation of an example that is based on the Shiller price-earning ratio. It's a cyclically adjusted one of the commonly used ones. And so let's see where we get from defining some entry and exit positions or signals rather, and then positioning ourselves in the US equity market. How does that perform in comparison to a simple buy and hold? So we're going to use as a RV, a relative value signal, the Shiller price earnings. And we are calculating this metric on a rolling 60-year window. This is something that's arbitrary, it's a parameter. And typically when you model such a trading strategy, you will play around with different time windows. Is it a cumulative one where you hold the starting date fixed, let's say 1990, and then you just continuously add more data to it, or you keep it a rolling window? One point to make here is an advantage of a rolling window is, and we will see that later, valuations change. They change secularly over time in the longer time, over longer time periods. And it's actually a good idea to have that window being rolling rather than cumulative, as it takes into account these changes in market conditions. Then, based on the rich and cheapness of the signal, will scale into equity investments in the range of 50 to 150%. If the signal shows the S&P Shiller price earnings is extremely rich, then let's say we have $100,000 to deploy, we'll be only investing 50% of it. However, if the index shows is very cheap based on the Shiller PE, then we actually use leverage and invest even more than we have. In this case, it will be 150,000. Okay, so this result, the results of this trading strategy is actually discussed in this paper here by Esnes and his collaborators in the paper called Market Timing Simulator. So what's the outcome of this? What you see here are in the top panel, the cumulative performance. In blue, we have just a simple buy and hold over a period from 1900 to 2015. And the green line represents the cumulative P&L using that strategy, using the Shiller PE as a signal to go underweight or overweight the US stock market, and try to contrarily, like in a contrarian fashion, time the market. And what you can see is actually it's outperforming. It's doing better. At the end of this period, you're way better off. The problem, however, is that this strategy has been predominantly generating money in this period here, let's say from 1940 to 1960, where these two cumulative P&L lines start to diverge. So the blue line, again, buy and hold, versus the green line, the value timing model. But since then, that gap has been more or less constant. It didn't change that much anymore. So it's actually quite a disappointing result, especially in the last 60 years or so. From 1960 until 2015, it's actually not adding that much value. And the reason why that's the case is what you see in this lower panel here, this second chart. It shows the exposure of your investments to the US stock market. So as I mentioned earlier, if valuations show extremely cheap, you go max your limited leverage, which is 150% of your holding. So let's say you have 100,000, you will go 150,000. And if the signals indicate that stock valuations are very rich, then you would reduce those holdings to 50,000. So your floor is at 50%. So you park your money in cash and just wait until the signal shows more attractive entry levels. So what you see here in this red circle is that most of the time, with the exception of around 1980, most of the time, this strategy indicated that you should be underweight stocks. That was the case from 1960 to about 1970, but then throughout the 1990s until like most recently, with one exception during the global financial crisis. So the stock markets in the 90s and then after the global financial crisis have been doing extremely well. We had QE in the last 15 years or so, and that was a big tailwind. And then we had like the big market rally during the 1990s. And as you can see, you missed out on all these positive gains during that time. And that is because the Shiller PE index was just signaling constantly very rich signals in valuations. So in the next video, I will talk a little bit more about that. I will talk about the diagnostics. I will look a little bit further into it and then try to explain why did we see that secular trend upward in valuations. Thanks very much for joining, and I will see you in the next video.